Imagine two friends, both 28 years old, who decide on the exact same day to start building passive income through dividends. Jake spends his weekends researching and carefully chooses 5 dividend companies that everyone online calls rock solid. He feels smart, almost like he's running his own mini hedge fund. Maya does something much simpler. She buys one dividend ETF that holds hundreds of companies at once. She doesn't pick a single stock, and honestly, she feels a little embarrassed, as if she's taking the lazy route. But 5 years later, one of them sleeps peacefully during market crashes, while the other wakes up at 2 in the morning checking stock prices. The surprising part is that it usually isn't the self-proclaimed genius who sleeps better.
Most people believe that picking individual dividend stocks is the more advanced and intelligent approach. It feels active and gives the illusion of control. You get to say, I own this company, I believe in it, and I did my research. Meanwhile, buying a dividend ETF can feel almost too simple, like you're just buying a basket and hoping for the best. But psychologists have a name for this feeling. It's called the illusion of control. Human beings naturally feel safer when they think they're steering the wheel, even when that control doesn't really change the outcome. Just like gamblers who throw dice harder because they believe effort affects luck, investors often confuse feeling skillful with actually reducing risk.
At its core, a dividend stock is ownership in one company. When that company earns profits, it shares a portion with shareholders, usually every quarter. A dividend ETF works differently. Instead of depending on one company, you're buying a basket filled with hundreds of businesses. Think of it like owning fruit from many different trees, instead of relying on a single tree. If one tree has a bad season, the entire basket still remains healthy. But here's where emotions become important. Jake becomes emotionally attached to the companies he personally selected. If one stock drops or cuts its dividend, it feels personal. That attachment often leads to something called the sunk cost fallacy, where people keep holding bad investments because admitting a mistake feels worse than losing more money. Maya never faces that emotional burden because no single company has the power to destroy her confidence.
Diversification isn't just about mathematics. It's also about protecting your emotions. Still, individual dividend stocks do offer one advantage. They provide more control and potentially higher returns. If Jake chooses the right company and it continues growing for decades, his gains could exceed what a broad ETF delivers. There are investors who bought great dividend companies many years ago and now collect income far larger than their original investments. But there's another psychological trap called survivorship bias. We hear stories about the winners, but we rarely hear about the thousands of investors whose once promising companies cut dividends, stagnated, or collapsed because of poor leadership, lawsuits, or changes in the industry. Individual stock picking creates extreme outcomes. A dividend ETF doesn't promise spectacular wins, but it also protects you from spectacular failures. What it offers is something much less exciting, but far more reliable: consistency.
And here's something that quietly changes how wealth is built. Boring often wins. Long-term wealth usually doesn't come from one brilliant decision. It comes from making steady choices that don't blow up and allowing time to do the heavy lifting. The investor who stays calm, avoids panic, and remains invested through difficult times often ends up outperforming the person who occasionally hits a home run but also suffers painful mistakes. The real question isn't which strategy makes more money. The real question is which strategy you can honestly stick with for 20 years. Because the best investment strategy isn't always the smartest one on paper. It's the one you can emotionally sustain without constantly worrying, second-guessing yourself, or giving up. So, if you're just beginning your investing journey, or if you know you're someone who gets emotionally attached to decisions, starting with dividend ETFs might be the better choice. Let diversification do the heavy lifting, while you focus on building the habit of investing consistently. Later, if you enjoy researching businesses and understand the risks, you can always add a few individual dividend stocks as a side project instead of making them your entire foundation. In fact, many experienced investors do exactly that. Looking back 5 years later, Maya, who once felt like she was taking the easy way out, ended up with a portfolio that allowed her to sleep peacefully through every market dip. Jake, despite feeling like the expert, spent years worrying, second-guessing himself, and sometimes selling at the worst possible moments. Because wealth isn't built by the person who chooses the most exciting investments. It's built by the person who never gets scared enough to quit.